There are 5 ways to harvest tax losses, and most investors are only doing one of them.
For the next 8 minutes, we're going to walk through all 5 in order from the one you're probably already doing to the one that 10 years ago didn't exist and today is an $86 billion product.
All right, so let's just start with tier 1. Tier 1 is manual. This is the version most investors already know. You own a stock or a fund, it's down from where you bought it, you sell it before the year end, you use the tax loss, the realized loss to offset gains you've already taken, or you carry that loss forward and use it in the future.
So $3,000 a year against ordinary income on the short term, unlimited against capital gains. Anything you don't use carries forward indefinitely.
The rule to know is it's called the wash sale rule. If you sell something at a loss and buy it back, or buy something, quote, substantially identical inside 30 days, the IRS disallows it. So you can sell a fund, but you can't buy it back for a month. Most people buy a correlated ETF in the interim to stay invested.
Yeah, but that's the real problem with manual. It's December, it's tax time. Everybody's doing the same thing at once. You're making decisions once a year when the market gives you whatever it gives you, and it's the floor. So every tier from here up is approved version on this, just done more often across more positions with more structure.
Right. Tier 2 takes the same manual process and just automates it. Wealthfront did it at first at scale, Betterment, Schwab, Intelligent Portfolios, and a handful of other versions of it that they're still around today.
Instead of once a year, the algorithms scan the account daily. When a position's down, it sells it. It buys a correlated ETF that isn't substantially identical and books the loss. So 31 days later, it can swap back in if it wants to.
It's real alpha for a taxable account. I mean, this really adds to your account. There's a decent academic work putting the number somewhere between 50 and 100 basis points a year, depending on the market environment. That is a lot of money. A 0.5% to 1% a year. It's a lot of money. It's not nothing.
No.
It really matters. We do it for every single client. We think it's really important to do.
However, there is a ceiling, and that ceiling is that the whole sleeve is one ETF. So we're a handful of them. So you can only harvest losses on the positions that are actually down. And if the S&P is up 20%, most of your sleeve is green. There's nothing to harvest.
That's right. So tier 2 is a real product, real value, but it caps out, which takes us to tier number 3.
Direct index.
That's right. Tier 3 is direct indexing. Instead of buying one share of the S&P 500 ETF, you own the 500 underlying companies and get direct exposure to those in your account. And your manager can basically sell one airline stock at a loss and buy another one.
This is a clear improvement. So you're getting the same market exposure, the same performance, tracking error aside. But now instead of one tax loss, you have hundreds, 500 in the S&P 500 in any given year. Even when the index is up, a third to half of those names are down. And that's, forgetting about the intra-year volatility.
The harvesting surface is bigger, so you have a lot more things to harvest. You're just giving yourself a larger surface. It's a lot bigger. And the academic research, pretty much, supports that this is a very, very good strategy. But there's a catch to it.
The catch is the benefit decays. So the first year, the basis of every stock equals its price. Everything is harvestable. But 5 years in, most of those positions have appreciated above their cost basis, and the pool of harvestable losses shrinks. The strategy works, but then it works less.
Yeah, so direct indexing is the workhorse. It's what a lot of thoughtful advisors are running all their taxable accounts on right now. But the decay problem is real. The fact that after a few years you run out of losses to harvest is exactly the problem Tier 4 was built to solve.
So take us through Tier 4.
Tier 4 is the one that fixes the decay problem and is the one everybody in the industry is talking about right now. It's called a tax-aware long short.
The Financial Times just covered it. They called it the hottest product in Greenwich. 2 firms, AQR and Quantino, have raised $86 billion running it in the last 12 months. And a few weeks ago, Fidelity stopped accepting new money for this into this version.
Yeah, it's kind of, so here's the mechanics. Instead of being like 100% long the market, just like a direct index, the manager runs a portfolio that's 140% long and 45% short. Okay, sometimes 250 long and 150 short. And the math works out to the same net market exposure because you're long and you're short, and it nets out. You're using a little bit of leverage in the strategy, but now you have positions on both sides of the book.
Which means you have harvested losses on both sides. If the market goes up, your shorts go down. Losses, if the market goes down, your longs go down. More losses. Either way, the strategy is manufacturing short-term capital losses.
That's right. And short-term losses are the most valuable kinds of losses because you can use them this year or you can carry them forward. That's why they're really valuable. And they're taxed at ordinary income rates up to 37% federal. Any excess cascades down to offset long-term capital gains, and 3,000 a year ordinary income then carries forward. So in other words, you can use short-term losses against short-term gains and you can carry forward what you own as long-term.
So for a client with a large concentrated stock position that they want to trim, let's say a founder or an executive with RSUs, somebody who wrote a single name for 20 years, and we see a lot of these folks these days, this is a strategy that makes tax efficient diversification possible. You run the long short sleeve alongside the concentrated position, you build up a loss bank, and then you use these losses to offset the gains when you sell.
Right. And two reasons to care about the $86 billion number. One is the money is going somewhere, and the managers running it have to find enough stocks on both the long and short side to actually invest that capital. And so capacity is a real question. Two, Fidelity's closure tells you that institutions are running this strategy, see a ceiling on how much they can do before the edge actually erodes.
So this is the tier that really changed what's possible. It's the one that kind of almost no retail investor, even wealthy ones, knows exists.
That's right. So tier five is the frontier. And we're going to be careful here because it's the most specialized and it's definitely not right for most people. And it's a phrase you'll hear from us and quote, and your tax attorney, if you use it, is, you got to be careful with these
Yeah.
things.
I mean, the concept is simple. Everything we've talked about so far, tiers 1 through 4, generates capital losses. And capital losses are good, but they're structurally limited. They offset capital gains. And only $3,000 a year against can be applied against ordinary income.
That's right. Ordinary losses are different. Ordinary losses offset ordinary income dollar for dollar with no annual cap. So if you make $1 million of ordinary income and you have $1 million of ordinary losses, the tax bill is zero.
The mechanism is a Section 475 election, mark-to-market treatment. Certain structures for certain taxpayers and certain vehicles can elect to have their trading treated as ordinary income and ordinary loss instead of capital. And the math changes dramatically.
Yeah, this is where we stop and tell you and what we tell our clients. This is a conversation for you and your CPA and your tax attorney. The structure that makes this work, Section 475 election, the entity setup, the ongoing compliance are specialized and they're not cheap and they're absolutely not for everybody. But a certain level of income and wealth, the math is hard to ignore.
Tier 5 exists. That's the point of including it. That's what we're talking about it. Most investors will never use it, but the ones who should need to know it's there.
So that's the full map: manual, robo-advisor, direct, indirect, Xing, tax-aware, long, short, and then ordinary loss structures. 5 tiers in order of sophistication.
Most investors are on tier 1. Thoughtful DIY investors and robo-advisor clients are on tier 2. The ones working with a good advisor are probably on tier 3. Tier 4 is what a lot of our conversations at Aligned are about right now. Tier 5 is rare and specialized and genuinely requires a tax attorney, but is really worth being aware of.
Absolutely. The point of the video isn't to tell you which one you should be on. It's to tell you that the map exists because the version of the conversation most investors have is, my advisor harvests losses. And the answer could mean any of one of those 5 things.
If you want to know what current setup you're actually on today and whether there's a better one for you, that's a conversation we have with clients at Aligned Wealth.
Yeah, and just to be totally frank, the investment world, especially public equity markets, is totally commoditized. And the reason why these strategies make sense is most people should be in more passive long-term strategies, trying to defer gains as long as they can and harvesting losses where they can. It's simple, it's easy, it works, and most active strategies really don't.
Humble, diversified, patient. We'll see you next time.
Thank you.